The committee will come to order. We will now resume our consideration of pending matters. Now, pursuant to notice, I call up H.R. 4293. The clerk will report the bill which was distributed in advance.
H.R. 4293 to reform the comprehensive capital analysis and review process, the Dodd-Frank Act.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from New York, Mr. Zeldin, the sponsor of the legislation, for 5 minutes.
Well, thank you, Mr. Chairman. I offer H.R. 4293, the Stress Test Improvement Act, critical legislation to inject transparency, consistency, and fairness into the stress testing process. This stress testing regime has been imposed on America's financial institutions under current law. Stress tests are one of the aspects of current law that is contributing to the climate of legal and regulatory uncertainty because the Federal Reserve has failed to provide the necessary transparency around this process. In testimony before the committee last Congress, Charles Calomiris, a professor at Columbia University, described the stress testing process as a Kafkaesque kabuki drama in which regulators punish banks for failing to meet standards that are never stated. Without needed reform, rather than assuring financial stability, the Federal Reserve stress tests are likely missing real risks while constraining the competitive flow of financial services that is critical to increasing economic opportunity. While a valuable resource, stress test results may be creating a false sense of security while at the same time sowing the seeds of financial instability. In order to succeed, a stress test must build from an accurate forecast of the next macroeconomic storm, and even the best forecasts tend to be wrong. Stress tests can only pretend to anticipate both the next big macro disruption and its interaction with a complex banking system. Even former Fed Chair Ben Bernanke has found that the smartest experts can't accurately model the risks that really matter for the financial system. In his 2013 book, Bernanke writes that during the financial crisis, quote, "The really hard thing to anticipate fully was that the effects of the decline in housing prices affected mortgages, which affected the soundness of the financial system and created panic, which in turn led to the instability of the financial system. So the whole chain of events was critical," end quote. Furthermore, viewing the world through centrally planned stress tests and risk-based capital standards stop Treasury, the Federal Reserve, and others from knowing where the systematic risk truly resides. Stress testing is cloaked in secrecy. There is no due process in the stress testing regime where regulators actively work to prevent those they govern from knowing what the law requires. Chairman Phil Gramm said it best when he responded, quote, "Isn't the fact that compliance is easier when you know what the law says the whole point of the rule of law?" By keeping their testing processes secret, Fed bureaucrats shield themselves from congressional oversight and public accountability. Without transparency about what the stress testing rules are, there's no way to ensure the government plays by the rules. Without transparency about the stress testing process, there is no way to know whether the Fed's testing is effective. By subjecting financial institutions to a questionable regime that lacks accountability and transparency, regulators are failing to achieve the important goals that they are tasked with, ensuring safety and soundness in the financial institutions. With the critical reforms in this legislation, we are upholding sensible standards for financial institutions while clarifying the requirements for and the frequency of stress tests. This may sound like a wonky debate over financial regulatory policy, but to real hardworking men and women in my district and nationwide, it is common sense that banks ought to know the standards and tests their regulators are subjecting them to. By injecting some transparency and consistency into the stress testing regime, we are taking needed capital off the sidelines so it can be invested into the private economy to create jobs and wealth. I want to thank Chairman Hensarling and Luetkemeyer for their leadership on this important issue. I also understand that my colleague, Mr. Scott of Georgia, is prepared to offer a friendly amendment to this bill, and I thank him in advance for his commitment to bipartisan support on this important issue. Working together on bipartisan solutions that improve access to lending and expand economic opportunity for our constituents is essential, and I thank Congressman Scott for his leadership and cooperation. With that, I urge adoption of this critical bill, and I yield back the balance of my time.
Gentleman yields back. For what purposes the ranking member seek recognition?
I move to strike the last.
Gentlelady is recognized for 5 minutes.
Thank you very much, Mr. Chairman. I'm opposed to H.R. 4293, And I'm disappointed to see another example of the never-ending effort to weaken important prudential advancements like stress testing for our nation's largest banks, following the largest financial crisis since the Great Depression. While it is appropriate for the committee to examine the effectiveness of enhanced prudential standards and how they are applied and tailored to our largest banks, H.R. 4293 would make a series of one-sided changes that weaken oversight of Wall Street banks. I share the concerns expressed by two committee witnesses about the dangers of rushing into rollback these reforms. Former Assistant Secretary of the Treasury, Michael Barr, testified that, quote, stress testing is a central and innovative risk management tool used since the financial crisis by both regulators and practitioners. Unlike fixed capital ratios of either the risk-based or leverage ratio type, stress testing seems to understand how macro shocks would deplete capital. It would be a serious mistake to hamstring stress testing by the Fed, quote unquote. Mr. Barr's fears were also echoed by Ms. Emily Leonard, Senior Policy Advisor at Third Way. She testified, and I quote, eventually there will be another economic downturn, and we need to be certain that our largest financial institutions can weather the storm so that we can return to growth, we can return to strong markets, and we can prevent massive investor losses far more quickly. If we had had stress tests before the financial crisis, we could have been prepared to take action before the chain reaction of bank failures unfolded, quote unquote. In the name of transparency, this bill would actually make it easier for mega banks to game the stress testing requirements and minimize their effectiveness as a crisis preparedness tool. H.R. 4293 would make certain stress tests less frequent and make it more difficult for regulators to make sure banks are adequately capitalized and prepared for future downturns. Even though banks are well capitalized today, we should not become complacent to how unexpected risk can quickly materialize and tank our economy. We should also not forget the lessons of the financial crisis and how costly and painful that was for our constituents and the country. So in that spirit, I must urge my colleagues to oppose this bill, and I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Mr. Chairman, thank you for the recognition, and I want to commend my friend and colleague, Congressman Zeldin, for offering a sensible proposal that would deliver some much-needed regulatory relief. And let me just say at the outset that I believe stress tests in general are a useful tool, and I think many financial institutions in this country would say the same thing. Stress tests, when properly applied, both internally and by regulators, can strengthen financial institutions' planning. They can help financial institutions plan for times of economic duress and help institutions make decisions that improve the resiliency of those firms. But the layering of stress tests under the Dodd-Frank law and the application of stress tests by the Federal Reserve, both in terms of the comprehensive capital analysis review and the Dodd-Frank Act stress tests, have become a bit of regulatory overkill, and maybe not a bit, but very overly burdensome and costly. And as a result, they've become much less effective in terms of serving as a tool to ensure safety and soundness. Today, the CCAR process eludes the most basic principles of due process. Notice in advance of the rules so that these institutions can comply and plan for the resiliency that we all want. And there's a basic principle of law in constitutional law called the vagueness doctrine. It's typically known to apply in criminal law contexts, but the void for vagueness doctrine is basically a constitutional rule that requires laws to state explicitly and definitively what conduct is unlawful. This is a basic principle that's embedded in the Due Process Clause of the Fifth Amendment, and laws that violate this requirement are considered to be void for vagueness. What that means is that the law requires fair notice of what is legal and what is not. And therefore, the vagueness doctrine helps prevent arbitrary enforcement of the law. The U.S. Supreme Court has applied the void for vagueness doctrine beyond the criminal law context. And in a case called FCC versus Fox, the U.S. Supreme Court held that the requirement of clarity in regulation is essential to the protections provided by the Due Process Clause of the Fifth Amendment. Why is this relevant to this discussion? Because if there was ever any process in administrative law that should be deemed void for vagueness, it's this. It's a total black box. No regulated institution knows what the rules are. And as Professor Calamaris, before this committee testified, he said that in addition to their economic costs and questionable contributions, current stress tests are also objectionable on the grounds of basic adherence to the rule of law and respect for property rights. Regulators not only impose unstated quantitative standards for meeting certain stress scenarios, they also retain the option of simply deciding that banks fail on the basis of a qualitative judgment, unrelated even to their own model's criteria. It is hard to believe that the current structure of stress tests could occur in a country like the United States, which prizes the rule of law, the protection of property rights, and adherence to due process. This is a classic description of a regulatory process that is void for vagueness. And so I applaud the gentleman from New York for his legislative solution here. Not only does it provide for advance notice to regulated parties to know what the stress tests are actually testing so that they can come into compliance with the law, adhere to the law, but also it gets rid of this vague qualitative assessment that is clearly violative of basic constitutional principles. Let me just conclude by saying also that I think the American people are tired of the rules being applied differently to the government as they apply to them. And so when stress tests apply to private regulated institutions and assess the safety and soundness, or supposed to assess the safety and soundness of these institutions, I don't think they like to see the entity regulating those banks violating those very principles. And the Fed has, in effect, become the king of banks, able to violate the very liquidity, leverage, and capitalization and regulatory standards that they impose on the regulated banks. So if we were to look at stress testing, let's stress test the Fed as much as we stress test these institutions, and certainly let's reform the stress test process to bring the process into the light of day and apply the principles of due process so that these stress tests truly can achieve their intended purpose and their important purpose. Thank you, and I yield back.
Mr. Chairman.
Time of the gentleman has expired. For what purpose does the gentleman from Georgia seek recognition?
Mr. Chairman, I have an amendment at the desk.
We will pause and allow the amendment to be distributed.
Hey, how are you?
The clerk will report the amendment.
Amendment offered by Mr. Scott, page 2, strike line 6.
Without objection, the reading of the amendment is dispensed with. The gentleman is recognized on his amendment for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, let me first of all thank Mr. Zeldin for beginning this conversation, and it's certainly a pleasure working with him. And I also want to make clear at the very beginning that what we're doing in no way weakens Dodd-Frank. We wouldn't do that. I also, Mr. Chairman, in setting up and explaining this amendment, I think you know that I've long been a student of Alexander Hamilton, our great chief architect of our banking and financial system. And it was Hamilton who said that the banking system of this nation is the heart. But let us not suffocate the heart's arteries with unnecessary, unneeded burden. It is within that spirit that I offer this amendment, and also the spirit of Barney Frank, who I worked side by side, and so did Ms. Waters there, and he himself said there will be times when we need to tweak. So I wanted to make that clear because there's no one I respect more than my ranking member, and when I hear that she may oppose me, I want to make clear to her that the spirit is in Alexander Hamilton and Barney Frank, and that too. So let me get to the point here. That while the baseline text of H.R. 4293, the Stress Test Improvement Act, is identical language to what we saw in Mr. Hensley's Choice Act. And that was something I could never support, and none of us Democrats support. So my amendment simply replaces that language with policies that bring the CCAR debate back to a normal playing field. So the goal of my amendment is to simply find places where we can streamline, take away unnecessary burdens within the administration of the test, not take away the test, without fully supporting or subverting our financial regulators' ability. That is the delicate weave that we are weaving. We want them to maintain the ability to conduct these tests. So let me make it crystal clear. This amendment resets the language so that we can have an honest debate in this committee about how to improve CCAR, something I think every committee member should want to do. So with that said, let me thank Mr. Hensarling for allowing us to consider our amendment, thank Mr. Zeldin, so that this committee can constructively debate the issue. First of all, the amendment does just three things. First, in today's CCAR test, banks are required to run stress tests that have a baseline, adverse, and severely adverse scenario. All my amendment does is takes away the adverse. Now, why is that? I've heard from numerous people and our constituents that this adverse scenario rarely sheds new light on the health of the bank that isn't already shown when the bank is testing for a severely adverse scenario. So this makes the middle of the road test a very wasteful way, because if you're going to have the stress test that shows severe, why do you need a middle one that just says adverse? Second, my amendment would eliminate the Fed's ability to reject a capital plan solely on the qualitative portion of the test. Stress tests are tests of both the bank's books, the quantitative side, and the test of the bank's internal controls, the qualitative side. So rejecting a capital plan solely on the qualitative portion of the test generates a lot of uncertainty for banks. That is something the federal regulators already earlier this year stopped requiring banks under $250 million, $1 billion, from having to do so. Simple. My amendment also says that through the rule of construction that the Fed can continue to whack the bad actors, get rid of the bad actors with every stick in their arsenal. We don't mess with that. So nothing in this amendment will disarm regulators from using it. And lastly, Mr. Chairman, right now, if you're a bank above a certain asset size, you are required to do internal tests. My amendment, lastly, just changes it so that the tests are done once a year, which is just a simply modest fix. Thank you, Mr. Chairman.
Time of the gentleman has expired. For what purpose does the gentleman from New York seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Well, thank you, Mr. Chairman, and I thank Mr. Scott for offering this very important amendment, which I strongly support. It's an amendment that attempts to address some of the concerns that exist in the underlying legislation, particularly related to issuing regulations subject to notice and comment for conducting stress tests and moving stress tests to a 2-year cycle, while also leaving in place important reforms that will reduce legal and regulatory uncertainty for financial institutions. The Federal Reserve's stress testing framework attempts to measure the ability of banks to withstand a very severe economic downturn and market shock. These include 3 supervisory scenarios: baseline, adverse, and severely adverse. Institutions must then assume that capital assumptions and baseline conditions will be implemented during adverse and severely adverse scenarios. According to Federal Reserve guidance, the severely adverse scenario should be constructed to match, quote, severe post-war U.S. recessions and, quote, generate scenarios that generate stressful outcomes but do not induce greater pro-cyclicality in the financial system and macroeconomy. The severely adverse set of assumptions are of the greatest importance because banks must maintain their capital ratios under all of the assumptions, and the severely adverse assumptions are the harshest, most likely ones that institutions are going to follow. This amendment would reduce the number of supervisory scenarios from 3 to 2, the baseline and severely adverse scenario. Doing so will simply reduce redundancy by allowing institutions to determine whether they have sufficient capital to absorb losses and support operations during the harshest economic conditions. In addition, this amendment will do away with mid-year stress tests. The mid-year stress test differs from the annual stress test as it relies on an institution's assumptions, and the Fed does not run its own stress test nor perform a capital plan review. Furthermore, this amendment would limit the Fed's use of CCAR qualitative assessment of an organization's capital planning process to prohibit the bank from making a planned distribution if the organization would satisfy the quantitative requirements. The Fed has used the qualitative assessment under stress tests as the reason for rejecting the capital plans despite institutions passing the quantitative stress tests. This is a particular area of concern because the GAO has determined, quote, transparency is a key feature of accountability, and limited disclosure of the qualitative framework may hinder understanding of the CCAR program and limit public and market confidence in the program and the extent to which the Federal Reserve can be held accountable for its decisions, end quote. Again, I strongly support Mr. Scott's amendment. I appreciate all of his work. His staff's work as well, working closely with mine and the committee. It's great that we're able to work together across the aisle to have a strengthened bill, and hopefully it will pass this committee, not only the amendment, the underlying legislation, with an overwhelming bipartisan support vote, and I yield back.
Would you yield to the chairman?
I yield to the
I
chair.
thank the gentleman for yielding. I want to thank the gentleman from Georgia for his very constructive engagement on what is, again, one of the more important bills that we are considering in this markup. I appreciate the gentleman from New York for his leadership, the bipartisan constructive engagement they've had for the improvements that are made to the underlying bill. The chairman certainly is prepared to accept the amendment and recommends its adoption. I yield back to the gentleman from New York.
I yield back to the chair.
Gentleman yields back. Is there any further debate on the amendment from the gentleman from Georgia? If not, the question now occurs on the amendment offered by the gentleman from Georgia, Mr. Scott. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. For what purpose does the ranking member seek recognition?
I have an amendment at the desk.
We'll pause and allow the amendment to be distributed.
Mr. Chairman? Mr. Chairman?
Who seeks recognition for what purposes? The
Like
gentleman
to
from Missouri.
reserve a point of order.
The chair has been informed that we have to begin the reading of the amendment prior to the gentleman reserving his point of order. If the gentleman will just hold a moment. Is this exactly what you gave us yesterday?
A little bit different, I think. It's a little bit different.
Clerk will report the amendment.
Amendment offered by Ms. Waters. Strike page 4 through.
Without
line
objection,
4
the
at all.
reading of the amendment is dispensed with. For what purpose does the gentleman from Missouri seek recognition?
Reserve a point of order, Mr. Chairman.
For an order is reserved. The chair recognizes the sponsor to explain her amendment.
Thank you, Mr. Chairman. My amendment would require that a megabank that has been found by the Consumer Bureau to engage in a pattern or practice of egregiously violating consumer laws should be prohibited from distributing dividends to pay the megabank's management and shareholders for 5 years. Like my amendment to improve H.R. 4292, this amendment similarly sends a signal to the megabanks that they can no longer harm millions of consumers and get off with a slap on the wrist. And bank regulators need to be much more aggressive to use tools like shutting down a bank's business line that has repeatedly harmed its customers. It is appalling that nearly every day, students, retirees, service members, veterans, communities of color, and others on Main Street learn that they are being ripped off by the mega banks. If the bank regulators are unwilling or unable to impose aggressive punishment when a mega bank demonstrates a pattern of abusive conduct, then Congress should. This amendment comes from a provision of my bill, H.R. 3937, the Mega Bank Accountability and Consequences Act, which requires the banking regulators to fully use existing statutory powers, such as the ability to shut down a bank that repeatedly breaks the law and permanently ban culpable senior executives from working in the banking industry to end recidivist mega banks' behavior once and for all. Dodd-Frank's stress tests and the Fed's Comprehensive Capital Analysis and Review, or CAR, have gone a long way towards promoting financial stability. However, the bank regulators do not seem to recognize that egregious consumer abuses, including those that harm millions of consumers, also constitute a threat to financial stability. My amendment would ensure that a recidivist megabank has a real penalty blocking its capital distribution through CAR when it continuously harms consumers. And my amendment makes it clear to the bank regulators that egregious violations of banking laws that harm millions of consumers must be taken more seriously. These patterns of consumer abuses threaten our nation's economy, and mega banks perpetrating them should be terminated. I urge adoption of this amendment, and I would yield back the balance of the time. Before I yield back the balance of my time, Mr. Chairman, let me just say this. I know that an amendment like this is extraordinary. I also understand that an amendment like this can only be embraced and adopted by those who are willing to step outside of the traditional way of doing things and the traditional way that we seem to want to protect megabanks, fearing that somehow a step like this is too big, too huge, and that people don't feel as if they can embrace something like this because it would be basically in opposition to the way things are normally done around here. And so I don't expect that there are many who would be willing to challenge megabanks in this way, not many who are willing to agree that the kind of fraud that has been committed by banks like Wells Fargo should be dealt with, and that we shouldn't continue to just go along to get along. And so having said that, I am serious about pursuing this kind of effort. And of course, I do have a comprehensive piece of legislation to do that. But I thought it would be meaningful and worthwhile to continue to offer it as amendments whenever I had the opportunity in order to get my colleagues thinking about what we do to mega banks who have a pattern or practice of ripping off our consumers. With that, I yield back the balance of my time.
Gentlelady yields back. The gentleman from Missouri is recognized on his point of order.
Mr. Chairman, I make a point of order that under Clause 7 of Rule 16, the amendment is not germane because it fails one of the major tests of germaneness, specific subjects to general propositions. The scope of the legislation is limited to stress tests within the jurisdiction of the FDIC and Fed. The amendment offered by the gentlewoman would broaden the scope of the bill and is thus not germane. Her amendment would co-opt a system intended to improve banks' resiliency and prevent banks from closing down, and instead give the CFPB the opportunity to use issues unrelated to resiliency to fail banks on their stress tests in a process that can ultimately lead to closing them down. Again, I believe that this is well beyond the scope of the bill and ask for the favorable decision on the point of order.
Does any other member seek time on the point of order? No other member seeks time. The chair has examined the amendment and listened to the arguments and is prepared to rule. The amendments expand the scope of the legislation. The precedents require the chair to find that the amendment does constitute, quote, amending a specific provision with a general proposition within the meaning of Clause 7 of Rule 16, and accordingly, the chair finds that the amendment is not germane and the point of order is upheld. Is there further amendment or discussion on the bill from the gentleman from New York? For what purposes, gentleman from Colorado seek recognition?
Unlike last night, I have an amendment at the desk.
We are hopeful that the member from Colorado does have an amendment at the desk this time. We will pause and allow the amendment to be distributed. The clerk will report the amendment.
Amendment offered by Mr. Perlmutter. At the end, add the following. Section 3.
Without objection, the reading of the amendment is dispensed with. For what purpose does the gentleman from Missouri seek recognition?
Mr. Chairman, I reserve a point of order.
The point of order is reserved, and the gentleman from Colorado is recognized on his amendment.
Thank you, Mr. Chair. My amendment would allow those states that have a regulatory structure in place with respect to marijuana, cannabis oil, or THC products to be allowed to do business with a bank without violating the banking laws of the United States of America. Right now, there are a number of rules in the regulatory confusion around marijuana and banking needs to be resolved. The purpose of the bill that we have before us is to minimize and eliminate regulatory confusion, provide some regulatory relief and legal relief. But the real purpose of the amendment that I offer, that says that if a state has a regulatory structure in place, that state is exempt from the banking laws that make it illegal to provide financial services to a legitimate business in that state, is to eliminate this confusion. There are now 30 states that allow for either fully recreational marijuana or medical marijuana, and 16 states that have legalized cannabis oil for particular seizures, epilepsy, and a number of other maladies. I don't think there's a single person on this committee that is in a state that doesn't allow some level of marijuana use. Only 4 states, as I count them, Nebraska, South Dakota, Idaho, and Kansas, don't have any laws pertaining to marijuana or the use of marijuana. Prohibition is over. This committee has a responsibility to align the laws of the United States with those of the states so that there isn't confusion. Public safety is at risk. In a number of the states, the banks and the credit unions are concerned about the federal law and won't provide financial services, which then results in a huge pile of cash being accumulated because the sale of marijuana in one form or another is allowed. By having these huge piles of cash, public safety is at risk. And Mr. Tipton would remember, as do I, we had a couple murders in Colorado for theft, where there was a theft, a robbery, and the guard was killed, a recently returned Iraqi vet who was standing guard. This is a real issue that this committee must deal with and confront and cannot overlook anymore. I would say to our chairman, even Texas now allows for cannabis oil to be prescribed for somebody with seizures and epilepsy. But under the federal law, it's illegal, and it is our responsibility to bring these laws into alignment. We've reached the tipping point. By far, the public sentiment is to support use of marijuana, certainly in some states, fully legalized, other states for medical purposes, other states for seizures. And we cannot hide our head in the sand anymore. We must deal with this and bring some regulatory relief and regulatory certainty to the banking and financial laws to allow legitimate businesses to have legitimate financial services. We know on the floor of the House that there is a majority in this House that would pass something like this. We've had it as attached to various appropriation bills. We need to offer this amendment, include it in this bill, and allow the laws of the United States to recognize what is going on in the country and not be ignorant. Right now, it is a Schedule I drug, which under the Controlled Substance Act says the drug has no accepted medical use in treatment in the United States. That's wrong. It isn't scientific at all. We don't even allow for research. This is the committee that can start changing this and recognize that prohibition is over with respect to cannabis. With that, I yield back.
Gentleman yields back. The gentleman from Missouri is recognized on his point of order.
Mr. Chairman, I make a point of order that under Clause 7 of Rule 16, the amendment is not germane because it fails one of the major tests of germaneness, specific subjects to general propositions. The scope of the legislation is limited to stress tests within the jurisdiction of the FDIC and Fed. The amendment offered by the gentleman from Colorado would broaden the scope of the bill to include depository regulations of the institutions with regards to deposits taken for cannabis-related businesses, His own statement in his discussion of this would indicate that we would allow the preemption of federal law by state law, which, if I'm not mistaken, would flip the Constitution upside down. So I would request that I believe that the bill is not germane to the underlying bill, and would request a favorable ruling.
Does any other member seek time on the point of order?
Yeah, Mr.
Gentleman
Chairman.
from Colorado.
I seek time, and then hopefully my friend from Georgia will assist me. So completely disagree with the gentleman from Missouri as to the germaneness of this amendment. The stress test is designed to determine whether a financial institution has a risky portfolio, potentially is subject to, losses, and in the United States, a risky loan would be a loan to a marijuana business, to a shopette that has a dispensary in it. There is, the stress test would put extra pressure on the financial institution. So if the guts of the bill is about the stress test, this fits right within it, okay? The other piece of this is the conflict between the federal law and the state law. I'm not saying that the state law preempts. I'm saying that as a federal matter, we need to change our law, which is what this amendment is designed to do, so that the states and the federal laws align. Those states, Nebraska, I think I ticked them off. Nebraska, South Dakota, Idaho, and Kansas, the 4 states that don't have any marijuana use, they can stay out of it. They don't have to. I'm not saying that they have to have marijuana laws. But I'm saying that the financial system must allow for these legitimate businesses to have legitimate banking services as a matter of public safety.
Will the gentleman yield?
Yes, of course.
I appreciate the gentleman's point. I mean, you're in a tough spot. I have a daughter, as you well know, that lives in Colorado, and when I visit her, we talk about this a lot. So I understand your position. I appreciate what you're trying to do today, but you're trying to make the point that by loaning money to these businesses, we are in putting the bank in a difficult spot. No, we're not, because right now, the way the law reads, that's an illegal action. You can't do that because you're enabling somebody to be in an illegal operation. So therefore, you can't do that to begin with. The other thing that you indicate here, in your discussion, Mr. Perlmutter, you indicated...
You may be right. I'm going to reclaim my time, but you just made my point. That's why this is germane.
Can I have another discussion with you?
I yield back to my friend.
Thank you. Well, that's the problem, though, is you're trying to make something legal here that is illegal right now. You can't solve the legality of this in this bill. You have to go to a different section of the law to make the transaction of buying and selling cannabis.
Reclaiming my time, the question is on germaneness. And so whether I'm changing the law or not changing the law as it applies to stress tests, so that's the question. Does this fit within the title of the bill and the purpose of the bill? And listening to the sponsor talk about regulatory relief and regulatory certainty and legal certainty, that's the purpose of this bill. He said it in his very opening statement, as did Mr. Scott. That's why this amendment, if there was any bill, I was going to stick it on, the capital markets bill. But this is really the bill for which it is germane, because it affects all financial institutions, it affects their portfolios, and this is something that would fit clearly within it. And so I appreciate my friend from Missouri making the point of order, but sir, you're wrong.
Will the gentleman yield?
I'd yield to the ranking member.
Well, first, just allow me to say to you that I respect all of the work that you have done on this issue. You are perhaps the foremost leader in this country in helping us to understand all of the issues related to cannabis. The experiences that you have had in Colorado should inform us about what we should do. I appreciate your sharing with us, teaching us. I support this amendment, and I want you to keep adding it wherever you have the opportunity. Someday, we'll come to grips with the fact that all over this country. Cities, towns, what have you, have
The
adopted
gentlelady will
legalization.
suspend. The gentlelady will suspend. The chair would remind all members that what is being debated are the point of order, and if members would constrain their comments to the debate on the point of order.
Continuing with my points of order, I congratulate you. I support you. You have done a wonderful job providing leadership, and as I was closing, I was saying someday we will realize that this is a federal issue that must be dealt with. Now I yield back my time.
Yes, Mr. Chairman.
I yield back.
Gentleman yields back. Does any other member wish to seek time on the point of order? For what purpose does the gentleman from Georgia?
Yeah, I'd like to strike the last word, Mr. Chairman.
Well, the gentleman is recognized to speak on the point of order. That is what is
yeah,
the
the
subject
point
of
of order.
debate. And comments
Thank you.
need to be restricted to the point of order.
I'm going to do all I can to make sure I do that, Mr. Chairman. I just want to say, in support of my friend from Colorado, if this point of order and his amendment is not germane, I still believe that this whole burgeoning issue certainly falls in the bosom of the Financial Services Committee. As we move forward, perhaps the chair can give us some instruction as to how we might pursue it. And here's my point, why I say it lies in the bosom of the committee. The gentleman from Colorado represents what really is the apex, the epicenter of this burgeoning financial, business, economic juggernaut, which is now marijuana. Now,
The
regardless
gentleman
of
will
what our-
suspend, and the chair will remind all members that we are presently examining the point of order. We have many other bills to discuss. Anybody who wishes to discuss the underlying amendment of the gentleman of Colorado will basically have the rest of the morning to do it, but at the moment, we are discussing the merits of the point of order and not the merits of the substance of the amendment from the
Okay,
gentleman from
well,
Colorado.
thank you for that correction, Mr. Chairman, and I respectfully would yield the balance of my time to Mr. Perlmutter.
Just, thank you, Mr. Scott. And to my friend from Missouri, to the chairman, I would say that at this moment, the country is operating under what's called the Cole Memo when it comes to banking and financial services with respect to marijuana. And that is a federal issue. And given the potential for banks and financial institutions to follow the Cole Memo, then be subjected to stress tests, and some regulators say, whoa, the Controlled Substance Act says you can't do this, or one other one says, you know what, Cole Memo says you can do this, which is both a memo out of the Treasury and the Justice Department. That is the kind of regulatory uncertainty that isn't fair, that my friend Mr. Barr talked about due process as being part of all of this. There isn't due process when you have a Cole Memo and a law and these stress tests which could fail a financial institution. Again, that's the germaneness piece of this. And I yield back to my friend from Georgia.
The chair has examined the amendment. I have listened to the arguments on both sides of the aisle and am prepared to rule. The amendment does expand the scope of the legislation.
Yes, I'd like to speak on the point of order.
Well, the chair is already prepared to rule. So the amendment expands the scope of the legislation. The precedents require the chair to find that the amendment does constitute amending a specific provision with a general proposition within the meaning of Clause 7 of Rule 16, and accordingly, the chair finds that the amendment is not germane and the point of order is upheld. Is there any further discussion or amendments to the bill?
I move to appeal the ruling of the chair.
For what purpose does
Chairman.
the gentleman from Missouri seek recognition?
I move to lay the motion offered by the gentleman on the table.
The question is on the motion offered by the gentleman from Missouri. All those in favor say aye. Aye. All those opposed say no. No. In the opinion of the chair, the ayes have it, and the motion is agreed to. Recorded vote has been requested. All those seeking a recorded vote.
Mr. Chairman,
For what purpose does the gentleman from North Carolina
a
seek?
quorum is not present.
The gentleman's point has been heard.
Mr. Chairman.
The clerk will
Mr.
call the
Chairman,
roll.
Mr. Chairman,
For what purpose does the ranking member seek recognition?
if you are accepting that a quorum is not present, or are you moving forward?
I'm sorry, say, does the,
The question has been made about a quorum, and what is, do you?
I'm sorry, the gentlelady will suspend. The gentlelady will suspend.
I'm not going to make this easy anymore. I'm not.
Shame on you.
I'm going to call a quorum.
The clerk will call the roll.
Mr. McHenry,
Is this a quorum call?
I'm sorry. Present. Mr. McHenry, present. Mr. King. Mr. Royce. Mr. Lucas. Mr. Pierce. Mr. Posey. Mr. Lukemeyer. Mr. Lukemeyer, present. Mr. Huizenga. Mr. Huizenga, present. Mr. Duffy. Mr. Stivers. Mr. Holcren. Mr. Ross. Mr. Pittenger. Mr. Pittenger, present. Mrs. Wagner. Mrs. Wagner, present. Mr. Barr. Mr. Barr, present. Mr. Rothfuss. Mr. Rothfuss, present. Mr. Messer. Mr. Tipton. Mr. Tipton, present. Mr. Williams. Mr.
The gentlelady is not in order. We will establish the quorum call.
Inquiry. At the point that you decided to have a quorum call.
The gentlelady will state her parliamentary inquiry.
Thank you very much, Mr. Chairman. At the point that you decided to have a vote on whether or not a quorum is present, there were people who were seated. After you made the determination, there appears to be folks who are getting up and who are leaving who may break the quorum. I want to know whether or not those folks who were seated when you decided to take the quorum vote are considered part of a quorum or not. I don't want people.
As members are present, they are noted in the quorum. If members disagree with the quorum total, they can once again raise a point of order that a quorum is not present. The clerk will proceed.
Mr. Poliquin. Mrs. Love. Mrs. Love, present. Mr. Hill. Mr. Hill, present. Mr. Emmer. Mr. Emmer, present. Mr. Zeldin. Mr. Zeldin, present. Mr. Trott. Mr. Trott, present. Mr. Loudermilk. Mr. Loudermilk, present. Mr. Mooney. Mr. Mooney, present. Mr. MacArthur. Mr. MacArthur, present. Mr. Davidson. Mr. Davidson, present. Mr. Budd. Mr. Budd, present. Mr. Kustoff. Mr. Kustoff, present. Ms. Tenney. Ms. Tenney, present. Mr. Hollingsworth. Mr. Hollingsworth, present. Ms. Waters. Ms. Waters, present. Mrs. Maloney. Ms. Vasquez. Mr. Sherman. Mr. Meeks. Mr. Meeks, present. Mr. Capuano. Mr. Clay. Mr. Lynch. Mr. Scott. Mr. Scott, present. Mr. Green. Mr. Cleaver. Ms. Moore. Mr. Ellison. Mr. Perlmutter. Mr. Perlmutter, present. Mr. Himes. Mr. Foster. Mr. Kildee. Mr. Delaney. Ms. Cinema. Mrs. Beatty. Mrs. Beatty, present. Mr. Heck. Mr. Vargas. Mr. Gottheimer. Mr. Gottheimer, present. Mr. Gonzalez. Mr. Christ. Mr. Kewen. Mr. Chairman.
Present.
Chairman, present.
The clerk will report.
Mr. Royce, present. Mr. Stivers, present. Mr. Hulkran, present. Ms. Velasquez, present. Mr. Green. Mr. Green, present.
The clerk will report.
Mr. Chairman, there are 33 members.
A quorum is established. The question is on the motion offered by the gentleman from North Carolina. The motion is on tabling the appeal of the ruling of the chair. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Mr. Royce. Mr. Royce, aye. Mr. Lucas. Mr. Pierce. Mr. Posey. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Stivers. Mr. Stivers, aye. Mr. Hulkran. Mr. Hulkran, aye. Mr. Ross. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Williams. Mr. Williams, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Poliquin. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Mr. Zeldin. Mr. Zeldin, aye. Mr. Trott. Mr. Trott, aye. Mr. Loudermilk. Mr. Loudermilk, aye. Mr. Mooney. Mr. Mooney, aye. Mr. MacArthur. Mr. MacArthur, aye. Mr. Davidson. Mr. Davidson, aye. Mr. Budd. Mr. Budd, aye. Mr. Kustoff. Mr. Kustoff, aye. Ms. Tenney. Ms. Tenney, aye. Mr. Hollingsworth. Mr. Hollingsworth, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Velasquez. Mr. Sherman. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Clay. Mr. Lynch. Mr. Scott. Mr. Scott, no. Mr. Green. Mr. Green, no. Mr. Cleaver. Ms. Moore. Mr. Ellison. Mr. Perlmutter. Mr. Perlmutter, no. Mr. Himes. Mr. Himes, no. Mr. Foster. Mr. Kildee. Mr. Delaney. Ms. Cinema. Mrs. Beatty. Mrs. Beatty, no. Mr. Heck. Mr. Vargas. Mr. Gottheimer. Mr. Gottheimer, no. Mr. Gonzalez. Mr. Christ. Mr. Christ, no. Mr. Kewen. Mr. Chairman.
Aye.
Chairman, aye.
Any member has not voted. Member from Florida. Gentleman from Florida.
Mr. Posey.
Gentleman from Maine.
Posey, aye. Mr. Poliquin, aye.
Gentleman from Michigan.
Mr. Kildee, no.
Gentleman from Massachusetts.
Mr. Capuano, no.
Gentleman from Maryland.
Mr. Delaney, no.
Is there any other member who has not voted? Does any member wishes to change his or her vote? Gentleman from California.
Mr. Sherman. Mr. Sherman, no.
Is there any other member who has not voted? Any member wishes to change his or her?
How am I recorded, Mr. Chairman?
Is there any other member who has not voted?
Mr. Chairman.
How am I recorded, Mr. Chairman?
Al Green of Texas.
Mr. Meek, you're recorded as no.
Gentleman from Texas.
And how am I recorded, Mr. Chairman?
Mr. Green, you're recorded as no.
Gentlelady from California.
Ms. Waters was recorded no.
Clerk will report.
Mr. Chairman. Mr.
The
Chairman.
clerk will report.
Mr. Chairman, the ayes are 28 and the nays are 14.
The motion is upheld. Is there any further discussion or amendments to the bill? There are no further discussion or amendments to the bill. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does gentleman from New York seek recognition?
Request a recorded vote.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 3299. The clerk will report the bill which was distributed in advance.
H.R. 3299 to amend the revised statutes, the Home
Without
Voter
objection,
Vote
the
Act.
bill is considered read and open to amendment at any point. The chair recognizes the committee will come to order. The committee will come to order. The chair recognizes the gentleman from North Carolina, Mr. McHenry, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. One of the biggest challenges facing America after the financial crisis is how to rebuild our financial system. While Washington was busy making new rules and restrictions for what's prohibited in banking, entrepreneurs were busy building a new framework for what is possible for the future of the financial system. What emerged is an exciting new era in financial services, otherwise called fintech, where innovation is built at the cross-section of both technology and financial services. These innovative companies partner with banks to help small businesses find loans, help young people get out of student debt, and help everyday Americans find the financing they need to lead better lives. While this era of financial innovation is the first of its kind, the actual structure that supports fintech is based on one of the oldest bedrock principles in American law. The fundamental concept of valid when made, or what the Supreme Court referred to as the cardinal rule in 1833, is that American interest rate laws provide the backbone of how fintech company partners partner with banks to go to the market. Yet, all of that changed last year when the Supreme Court declined to hear the case Madden versus Midland. In Madden, the federal appeals court broke with longstanding legal precedent of valid when made, and it held that the National Bank Act does not have a preemptive effect on loans created under this fintech bank partnership. So, enormous break of nearly 200 years of legal precedents. This unprecedented reading of the National Bank Act is bad law. The former Solicitor General for President Obama said that, in essence, noting in their brief before the Supreme Court that the Federal Appeals Court got it wrong when, quote, when applying, quote, the long-standing principle of valid when made, end quote. Consequently, this decision has created uncertainty for fintech companies, financial institutions, and the credit markets. A recent study by professors from Columbia, Fordham, and Stanford universities quantified the impact of the Madden decision on American consumers in the Second Circuit. The study found that Madden significantly reduced credit availability for hardworking Americans. Loan volume declined, the average FICO score for borrowers that could get loans increased, and the only group of consumers not negatively impacted by Madden were those consumers with FICO scores of 700 or above. Now, I think we should agree on this committee that we should be helping those on the margins get credit and access the financial system. We've had great bipartisan cooperation to achieve those things. At this point, if we are serious about financial inclusion, we need to fix this in this new interpretation of the law. If we are serious about helping more of America's small businesses and consumers have access to useful and affordable financial products that meet their needs in a safe way, then we need to fix this unprecedented interpretation of law. And we need to do this in a bipartisan way. To that end, I'd like to thank Chairman Hensarling, Representative Meeks, my Democrat co-sponsor here on the committee, Senators Mark Warner, a Democrat from Virginia, and Senator Pat Toomey, a Republican of Pennsylvania, for their sponsoring the companion bill in the United States Senate. We've worked hard to make this a bipartisan approach to fix this really unprecedented break with longstanding existing law and to help financial inclusion. And so with that, I yield back the balance of my time and ask my colleagues to consider this an opportunity to be bipartisan and to work for financial inclusion. I yield back.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I move to strike the last.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, while I appreciate what this bill is trying to accomplish, I cannot support it, and I would like to be supportive of any efforts to extend credit, particularly to those who have been denied. And I've worked with Mr. McHenry in the past on legislation, and I always look forward to the opportunity to work with him. But this bill bothers me. For years, third parties have availed themselves of the privileges of the National Bank Act by partnering with federally chartered banks. While these types of partnerships can potentially help to provide access to credit in underserved communities by allowing institutions to offer services for a lower cost, they have also historically served as a vehicle for nefarious lenders to charge consumers extremely high interest rates that the lenders otherwise would not have been able to offer absent their connection to a federally chartered bank. Unfortunately, I believe that allowing third parties that buy debt from national banks to collect on interest rates that preempt state usury laws would advance that dangerous precedent. So I cannot support this bill because I do not believe that preempting strong state laws that protect consumers is the best way to help underserved consumers, nor low and middle income customers. Again, I appreciate the way that the author is attempting to open up opportunities for underserved communities. This is not the way to do it. At what price? Credit. And so I would yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Indiana seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Well, I too wanted to rise in support of this legislation. I think it is tremendously important that we maintain, as my friend Mr. McHenry said, nearly 200 years of legal precedent on valid when made. The secondary market and the trading of loans after they're made is tremendously important to enable capital to get out to borrowers. Enabling balance sheets to be turned over more frequently was a tremendous innovation that truly enabled more capital to get out to borrowers, a wider variety of borrowers, and for more borrowers to be included in the financial system that might otherwise be marginalized. And as Mr. McHenry said, many of these borrowers that have been included were those of lower credit scores or might otherwise not be able to access credit availability to be able to meet their family needs. And so I think Mr. McHenry's bill here is narrow. It corrects a problem that has been recently created despite 200 years of legal precedent. It is both bipartisan in the House and bipartisan in the Senate, and I strongly support it. And I would yield my time to Mr. McHenry if he needs such time, or back to the chair.
I thank my colleague for yielding. Thank you, Mr. Hollingsworth. saddened that the ranking member is not supportive of this approach, but I'm grateful that she has worked with me on previous items, and grateful for her input to improve products. We are trying to fix the same thing, which is ensuring those that are at the margins have access to affordable credit. And this is a new iteration of peer-to-peer lending, but even peer-to-peer lending has changed over the last year or two. And we need to ensure that we can use technology to get those that have lower FICO scores get competitive credit, cost of credit. And that's really what this is about, and that's the drive of this. And I'm grateful for my friend and colleague, Mr. Meeks, for his work on this. We wouldn't be here today without his great input and work. And I thank Mr. Hollingsworth for yielding and yield back.
Would it yield to the chair?
I will yield to the chair.
I thank the gentleman for yielding. One, I want to thank the vice chairman of our committee for his leadership on this issue. Again, this is a very serious matter to have one court in the land really upset probably 2 centuries of historic precedent. And I'm afraid that if we do not enact the bill of the gentleman from North Carolina to ensure that valid when made remains a valid legal concept, that the consequences are going to be adverse, and as the gentleman from North Carolina puts it, particularly for those who are on the margins. If we don't correct this problem, there are going to be low to moderate income people who will not be able to find the credit necessary to buy a car to get them to and from work. Maybe they will be denied that opportunity to finally get their piece of the American dream and reach for home ownership. Maybe a medical bill that has to be paid can't be paid because credit becomes more expensive and less accessible. And so I very much appreciate the way that the vice chairman has approached this, and I want to thank him for working on a cooperative bipartisan basis. I know that Mr. Meeks has co-sponsored the bill, as has Ms. Moore on the other side of the aisle. I'm sorry that the ranking member didn't get there on this bipartisan piece of legislation, but I do note that it is still a strong bipartisan piece of legislation, and frankly, it enjoys bipartisan support on the other side of the Capitol as well. So I remain optimistic that this challenge to credit availability and cost to low and moderate income people, that it will be, that this problem will be solved. And again, I just want to thank the vice chairman for his leadership on this critical issue. I yield back to the gentleman from Indiana who yields back. For what purpose does the gentleman from New York seek recognition?
Strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Today, I urge my colleagues to support the Protecting Consumers' Access to Credit Act because this bill encourages the bank partnership model, which has potential to close troubling gaps in access to affordable financial services. See, since the financial crisis, all members of this committee have witnessed traditional banking through brick and mortar branches decline in their districts, no more shining than in mine. According to the National Community Reinvestment Coalition, between 2008 and 2016, over 6,000 bank branches closed their doors. 82% of branch closings were in urban areas like the one I represent. This created 100 bank deserts where individuals travel as much as 10 miles to access their nearest branch. Nevertheless, what I've been encouraged by is the innovative partnerships we have witnessed between banks and financial technology firms. According to the Philadelphia Fed study, bank partnerships with fintech firms have facilitated well-regulated lending in communities where branches have closed since the crisis. Furthermore, the study found that a fintech firm's use of alternative data has expanded access to lower-priced credit for riskier borrowers. This bill would facilitate such affordable lending to those who need it most. H.R. 3299 is also a community bank bill. Fintech firms have partnered with small community banks and provided these institutions with technological expertise needed to contend with larger competitors. In fact, I'm aware that there are fintech firms engaging with Black-owned banks who have benefited tremendously from new technologies. H.R. 3299 is also a small business bill. Over the years, we've witnessed fintech firms partnering with community development financial institutions, CDFIs, including a partnership between Lending Club and Opportunity Fund, which brought around $10 million in loans to 400 small businesses in underserved communities throughout California. And last, H.R. 3299 overturns Madden v. Midland, a poorly decided court decision that has hindered bank partnerships in New York, Connecticut, and Vermont. After Madden, while bank partnership loans thrived nationwide, they virtually disappeared in New York and Connecticut for borrowers with credit scores of 644 or less. That's according to an independent analysis from law professors from Columbia, Stanford, and Fordham University. So where do these individuals go in my district? According to the Urban Institute, 34% of my constituents in Jamaica, Queens, who have bank accounts rely on alternative financial service providers, including rent-to-own agreements and refund anticipation loans, because they have unmet lending needs. This rate is higher than the national rate of 20%. Madden does little to help these underbanked individuals. Instead, it shuts the door to more affordable bank loans facilitated through partnerships model. So I want to thank Gwen Moore for co-sponsoring, and I also want to thank Patrick McHenry for working with me and including a provision reaffirming that nothing in this bill precludes the CFPB and the federal banking agencies from enforcing their consumer protection laws. In fact, loans provided through bank fintech partnerships must comply with 1, Truth in Lending Act, 2, the Federal Trade Act, 3, anti-discrimination and fair lending laws, 4, the longstanding guidance against rent and bank arrangements, and 5, and most importantly, nothing in this bill prevents the CFPB from stamping out unfair, deceptive, and abusive acts of regulating payday lenders. Any suggestion that this bill is a backdoor for payday lenders is false. In fact, the CFPB has been engaged on this issue and recently provided a no-action letter to Upstart, a fintech firm that uses the bank partnership model. Here, the CFPB's goal is to facilitate what it calls consumer-friendly innovations where regulatory uncertainty may exist for emerging products or services. This committee should also play its part in preserving access to affordable credit by removing legal uncertainty that can push the most underserved consumers to riskier and less desirable financial options. And I yield back.
Gentleman yields back. For what purpose does the gentleman from Pennsylvania seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I thank the chairman for yielding, and I also want to express my support for Vice Chairman McHenry's bill, the Protecting Consumers' Access to Credit Act. At this committee, we have extensively discussed the difficulty that many Americans face in getting credit. By codifying the valid when made doctrine, this legislation would address a significant risk to the secondary credit market. As the OCC's acting controller, Keith Noriega, noted, quote, "This proposal supports economic opportunity, and it addresses a problematic uncertainty by eliminating the differences in treatment of loans made in different judicial circuits. H.R. 3299 would help to keep credit flowing through traditional channels to those who need it, while ensuring that consumers are protected." I support this legislation, and I urge my colleagues to support its passage as well. We talk a lot on this side of the aisle about simple provisions, bailouts for none, opportunity for all. This legislation seeks to make sure that we are expanding opportunity for everyone, particularly those who need it most. Again, I encourage my colleagues to support this legislation, and with that, I would yield back to the chairman.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I have an amendment at the desk.
We'll pause and allow the amendment to be distributed.
Mr. Chairman and members,
We're going to allow the amendment to be distributed. The clerk will report the amendment.
Amendment offered by Ms. Waters, strike Section 2.
Without objection, the reading of the amendment is dispensed with, and the gentlelady is recognized for 5 minutes on her amendment.
Thank you very much, Mr. Chairman. As I discussed earlier, I do not believe that preempting strong state laws that protect consumers is the best way to help improve access to credit. Earlier this year, 20 state attorneys general, including from California, strongly opposed a similar provision that was tucked into H.R. 10, the Wrong Choice Act, because it, let me quote, would make it more difficult to ensure that debt buyers, online lenders, fintech companies, and rent-a-bank schemes comply with state interest rate caps. It is essential to preserve the ability of individual states to enforce their existing usury caps and oppose any measures to enact a federal law that would preempt state usury caps, quote unquote. So instead of taking up H.R. 3299 as is and working to protect third parties' ability to enforce these high interest rates, I believe we should be having a conversation about how to prevent predatory consumer lending. As you know, the Military Lending Act keeps our active duty service members and their dependents from being charged an interest rate higher than 36% on most types of consumer loans, as well as providing other significant rights to covered consumers. And let me just say, I think 36% is high, particularly when there are those who are able to get loans at significantly lower rates. I'm talking about at market rates. And so I believe that the Military Lending Act is a step in the right direction, and that those same protections can be extended to consumers across the country in the absence of stronger state-level consumer protection laws. That is why my amendment would limit the bill's provisions to loans made to consumers with an annual percentage rate of 36% or less as calculated according to provisions in the Military Lending Act. And let me just say this. Again, let me repeat. I think 36% is high. But as I have checked when we were considering this bill, I discovered that these predatory lenders could go as high as they want to go. We're talking about they could charge 50%. Now, if there are those who are saying it doesn't matter what consumers are charged, that if they can get a loan and if it's at 50% or 60%, that's okay. I say that's not okay. And while I think 36% is high, and that is not what, average Americans who work every day and have the ability to get loans at our banks and our financial institutions are not paying any 36%. And though my amendment may not solve all of the nation's predatory lending issues, at least I'll start here. So I would urge my colleagues to adopt this amendment that would say the loan should be no higher than 36%.
Will the gentlelady yield?
That's very reasonable.
Will the gentlelady yield?
Yes.
Just as a colleague, to drop this at the last minute, I've worked with you on crowdfunding. We've passed law. We haven't talked the talk. We've actually done the hard thing, and you have come to me with hard objections to bills that I think are excellent, and you've made them better, and we've got them into law. I worked with you on the Angel Bill, worked with you on the RAISE Act. We got 3 pieces of legislation. They're really important to me, and you worked with me on this. I know you're sincere about this. We don't want people to exposed to very high interest rates, but had you worked with us before we put it into the Choice Act, we filed this last Congress. I've tried to get you on board with this bill for the last year and a half, and you weren't keen to it. I'm not saying it. But to drop this at the last minute is, I'm sorry. I'm sorry. I'll address it to the chair. I think the ranking member has done a fantastic job of working with me on important pieces
Will
of
the
legislation.
gentleman yield?
And I just wish that we'd be able to had more
It's
time to
on my
work this
time.
out.
That's your
I'm
time.
sorry. Reclaiming. Let me just say this, that I understand the argument that you're making about the timelessness, but when I discover this kind of problem, even if it is at the last minute, I have to speak up for the average American out there. If you cannot agree that 36% is reasonable, then something's wrong with the way that we're approaching this. I do believe.
Time of the gentlelady has expired. Who seeks recognition? For what purpose does the gentleman from North Carolina seek recognition?
To oppose the amendment, to strike the last word.
Gentleman is recognized for 5 minutes.
And the ranking member is generous with her time, and I'm happy to yield to her to finish her thought.
Well, thank you very much. I appreciate that. And all I'm saying is this. I accept your concerns about this not being as timely as it should be. And I'm trying to recall when we have talked about this or when we have attempted to work on it, and I can't recall that we really have engaged on it. But when I discovered that this was, a preemption of state law, I was concerned. But I'm really concerned about the fact that there is no cap and that that these loans, the interest on these loans could go as high as the sky. And the thought of that is shocking to me. And what I'm offering, I think, is reasonable, 36%. And why not, if it's good enough for the service members of our society, then I think it's good enough for those people that you say that you want to help, that are living in communities that have been described as deserts for lending. Sure. So I would just simply ask you to consider this 36%.
And reclaiming my time, Mr. Chairman, I thank the ranking member. I believe in the sincerity of her amendment. I do not know the full ramifications of it, and nor have I had time to look at the language to see if it's commensurate with other existing federal laws or what it does to the various 50 state regimes that we currently have. And as such, I think, given the nature of this and the importance of this, setting a federal interest rate number for everyone in an amendment that was proposed to us that I've had about 8 minutes to look at now, I think is not the right way for us to legislate. I'd ask my colleagues to vote down this amendment. I'm happy to work with the ranking member on this matter. If she'd be willing to withdraw the amendment, I'd be happy to work with her on the essence of this before we go to the floor. But absent that, we should vote this down and pass this bipartisan bill.
Gentleman, yield back.
Yes.
Is there any further debate on the amendment? For what purpose does the gentleman from New York seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you. I support the ranking member's amendment. There's no question about her focus and dedication to make sure that individuals who are in need receive the kind of financial services that they deserve. For me, in doing some of the research that I've done, I found that, especially with fintechs and true partnerships, and those that I've talked about, they're under the 36% interest rate now. And we want to drum out those bad apples who would charge excessive money, excessive interest rates. In fact, I'm a big supporter of the true lender court-based theory, because what I'm concerned about is to make sure, and I think that anybody in fintechs are concerned about making sure there's true partnerships with banks and not shams. And with the true lender court-based theory, there's, which I'm fully supportive of, we can get rid of the bad apples. I don't want the bad apples to destroy it for everyone and thereby leave a community where there are deserts without the kind of financial access to financial services that they need. Because I've seen at times when there are no opportunities for them, people need to borrow money, they're going to figure out a way to either go straight to payday lenders where they can go, or to loan sharks. And I want to make sure that they have this opportunity, and I appreciate the manner and the dialogue, so I would hope that we can work this out. And I strongly support this amendment. I think this amendment would go a long way in improving. In any bill, there's no perfect legislation. All bills can be improved, and so I would strongly support this amendment and urge my colleagues to vote aye on the amendment. You.
Gentleman, yield back. Does the gentleman yield his time back? Gentleman from New York.
I yield back.
What purpose does gentleman from Missouri seek recognition?
Strike last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Yeah, I tend to agree with the gentleman from North Carolina. It's kind of a late addition here to his bill. And we don't have in the bill here, which it's a very broad amendment. It says it's going to apply to all loans. We don't know what, from the standpoint of which ones we're talking about, but it says all loans. So, I mean, this is going to hurt the ability of some folks to have access to credit. It's going to drive some loans out of the system offshore. This is not where we need to go at a time when we're getting something here that's actually going to improve the system as a whole. You know, the underlying bill basically talks about helping consumers have better access to credit. It lays uncertainties within the markets, helps improve liquidity of the banks. And here we have an amendment that, quite frankly, is going to add some uncertainty to what we're trying to do here with giving certainty. So again, I'm concerned about it, and looking where it goes into the bill here, I'm also concerned about how it's affecting some of those sections. And without time to really assess that, I'm certainly not going to be supportive of this, and I would urge a
Will
no
the
vote on
gentleman
this.
yield?
Yes, I will yield to the ranking member.
Thank you very much, and I appreciate that. You said one of your concerns is whether or not, well, you said the bill would affect all loans. Are there some loans that you think are deserving of more than 36% in interest?
Reclaim my time. I think we have to make a determination on what kind of effect this has, what kind of loans it's going to affect, and access to credit for various individuals. So I understand the gentleman from Pennsylvania has a request for some time. I'd yield some time.
Thank the gentleman. You know, I thought this was a simple bill to simply restore a common law doctrine of VIII when made. While we did not reserve a point of order, you know, it seems like this is somewhat not germane because this is a simple doctrine we're trying to restore. I do notice that the amendment seeks to strike Section 2 all in its entirety. It's interesting, though, in Section 2, we do have findings. For example, in 2016, the Solicitor General, in consultation with all federal banking regulators, filed an amicus brief that described the United States Court of Appeals for the Second Circuit in that case as incorrect. In 2016, the Solicitor General, that would be the Solicitor General in President Obama's Justice Department. Also, in seeking to strike Section 2, we're looking at, on page 3, the language, paragraph 5, a joint academic study from professors at Stanford, Fordham, and Columbia universities concluded that the Madden versus Midland decision has already disproportionately affected low and moderate income individuals in the United States with lower FICO scores. Again, it seems that the ranking member's amendment would be the subject of a separate piece of legislation worthy of debate, but that's not what this bill is about. This is a bill, a simple bill, to restore a common law doctrine that was advocated for in President Obama's Justice Department. With that, I would yield back to the...
I thank the gentleman for yielding back. As I continue to read the amendment here, I think the gentleman from Pennsylvania makes an excellent point because it strikes the entire Section 2. The Section 2 of the bill is the guts of the bill. This is the one that makes the Madden versus Midland valid when made doctrine obsolete. This is the one that has a study in there to request what's going on here. This basically, in my mind, maybe I'm misreading this, but it looks to me like you're gutting the bill with this amendment. So I was distracted by the balance of it that looked at the interest rate. But as I go on and read this, unless I'm reading it incorrectly, it says strike section 2 right there at the very beginning, and then it goes on to page 4, which means you basically gutted the bill. I obviously am against that, certainly oppose that. Mr. Chairman, with that, I yield back, balance on my time.
Gentleman yields back. For what purpose does the gentlelady from Ohio seek recognition?
Move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. As I've been sitting here listening to the dialogue, I was not a supporter of the bill, but I am a supporter of the amendment. And while we're having a lot of discussions, we've done some good things this week on a few of the bills that talked about allowing families to have self-sufficiency. I've also sat in this committee and listened to my colleagues on the other side of the aisle talk about if we're too generous to someone and they get into a home, or if they buy something that they can't maintain, that we shouldn't do this. Well, I'm from the great state of Ohio, and we have one of the highest payday lending percentages in the United States. So like Ranking Member Waters, 36% is high. We've tried to cap it during my days in the General Assembly in Ohio to 28%, and people thought that was high. So while we sit here, we talk about we want to make sure that people can maintain an appropriate lifestyle and not overspend. I'm concerned that this may open an avenue for some payday lenders to also partner. You know, while I have all the respect for fintech and new technology and what they're doing, but I think you have to look at that there are some people who are not here for the good of our constituents. So when you think about what the bill has the possibility without a cap to open up, it is certainly a lot more scarier than us asking for a 36% cap. I also heard the author, McHenry, of the bill to say he would be willing to work with it. I just think when you look at the bill that we're going to get more good universally of protecting our constituents by taking this amendment and voting on this amendment. So I am very much in support of Congresswoman Waters' amendment, and I yield back my time.
Gentlelady yields back. Who seeks recognition? Chair recognizes himself. I would like to point out to all members that this bill of the Vice Chairman was introduced on July 19th of this year. It was noticed on October 5th, which is approximately 5 weeks ago. And we see this amendment for the first time approximately 15 minutes ago. And so, again, I have no doubt that the ranking member is serious about her amendment, but we would take it more serious, given that the bill was introduced in July, noticed on October 5th, had she chosen to work with the sponsor of the bill before now. And so something that receives no notice on the majority side has to be presumed to be a messaging amendment. All members have the right and the privilege to offer messaging amendments. But they should not assume that if they give the majority 15 minutes notice, when the minority has had months notice of the underlying legislation, that again, they should not have a serious expectation that it will be included in the legislation. Again, this appears to set a federal usury standard of federal price control, which is a very serious matter that would need to have extensive debate. People ask, do you believe in 36%? Well, I don't know. I don't really believe in $100 hamburgers, but I'm not sure I care to sign up to a law setting a federal price control on hamburgers. Question is 36 APR too much? Well, what is the APR on getting evicted out of your apartment because you can't pay your rent? What's the APR of not being able to get your car back from the automobile mechanic in order to go to work on Monday? What's the APR of not being able to go to the grocery store and buy milk for hungry and thirsty children? I'll leave that for the consideration to the committee as well. Again, what started out as a rather simple bipartisan matter to assure that some people are not inadvertently driven to loan sharks, that their ability to gain credit for some of the needs that I just indicated, a very simple bipartisan bill, has now been sent in a completely different direction with no notice whatsoever. I believe that this amendment should be thoroughly rejected and that the underlying bill, that is a bipartisan bill, should be adopted. And unless any other member wishes to have some of this time,
Green from Texas, Mr. Speaker. Mr. Chairman, excuse me.
I'd be happy to yield to my friend.
Thank you, Mr. Chairman. Thank the ranking member as well. We honor our service people, and we take the opportunity to protect them because they protect us. We're protecting them by having a usury rate. We don't want them to be taken advantage of. And because we don't want them to be taken advantage of, we all would join in and celebrate this usury rate. But I believe that the people who serve in our military and the armed forces, I believe that they serve not only to have themselves protected, but to have every American protected.
Reclaiming my time, I sense this is not in response to what I have said, so I'd be very happy to recognize the gentleman on his own time. For what purpose does the gentleman from Texas seek recognition?
Thank you, Mr. Chairman, and that was my intent when I spoke up. I thought you had finished.
The gentleman is recognized for 5 minutes.
Thank you, and if I need to yield time to you, of course you know I will. Thank you. I believe the persons that serve in our military desire to see all Americans treated fairly and equally. I don't believe that a poll of the military would reveal that the men and women who serve would want anything less for the country that they protect and serve than they themselves receive. I don't think the military would support this. I believe the military would be in favor of what the ranking member is proposing. Equality of treatment. Why not use the same number for the military, the same number for American citizens that we use for the military? Why not? Why not? What is arbitrary about doing the same for Americans as you do for the military? What's arbitrary about that? What's capricious about that? Why is that not something that is acceptable to all Americans? And I will challenge anybody to show me a poll indicating that the military would want some higher percentage rate for others than they themselves receive. And I'm prepared to yield to any person who has such a poll. It's my time, and I'm yielding. It's my time, and I'm waiting. Who can deny that this is discrimination against the people that the military defend and protect? I'm going to vote for this amendment because I'm voting for the military and all of the people they protect. This is a great country, and it's great because of what people are willing to do, the sacrifices that they're willing to make, and they make them for all of us, not just for themselves. I'm still waiting.
Would the gentleman yield?
I will yield.
Mr. Chairman, having worn our nation's uniform and served in the military, I certainly can't speak for all who do serve or have served, but I can say that one of the highlights of my life was being in Germany when the wall came down. And speaking with East Germans who were literally spending their first hours in the West, one of the most poignant things was, is it like this everywhere? And as a kid from Western Ohio, I thought he was talking about how big Berlin was. And he said, no, there's fresh milk on the shelves. And the shelves are stocked. The stores are open at night. Can everyone go in or only certain people? See, that's what they had experienced on the other side of this wall that had held them captive behind a Marxist ideology. That's the land of price controls, of government rationing, and one-size-fits-all central planning. And I think we can realize that America won that, not by tearing down the wall ourselves or convincing Mr. Gorbachev to tear down the wall, but because the East German people found out the truth, that free markets and freedom had produced wealth and opportunity that outperformed anything that they could even believe.
I thank you for your commentary, but I will have to reclaim my time because I have now less than a minute. Free markets are not free unless all can enjoy the free markets. You can't claim that you have a free market when you're according some advantages that others don't have. The military didn't go to war to protect the rights of people who wear the uniform. They went to war to protect all Americans. And if we're going to fight for military people to have certain opportunities, I cannot imagine us allowing that to happen without according these same opportunities to others. We have divided ourselves too long along the lines of the military will get this sort of special treatment, but the people that they fight to protect won't. It's time to face the facts and face the truth. Every person in this country deserves the same treatment when it comes to these usury rates. I'll yield back.
Time of the gentleman has expired. Is there further debate on the amendment? Question now occurs on the amendment offered by the ranking member. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay, in the opinion of the chair, the nays appear to have it. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. Sufficient number having raised their hands, a recorded vote is so ordered and pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Is there further amendment or discussion? If not, there being no further amendments, record votes on the pending amendment has been postponed. Once that vote is taken, the committee will immediately consider the motion to report the measure. I now, pursuant to notice, call up H.R. 4247. The clerk will report the bill, which was distributed in advance.
H.R. 4247 to repeal Title VIII.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from North Carolina, Mr. Budd, the sponsor of the legislation, for 5 minutes.
I thank the chairman and I thank the committee. This bill repeals Title VIII of the Dodd-Frank Act, which empowers the government to designate financial market utilities as systemically important and give those organizations access to the Federal Reserve discount window. In plain terms, this section of the Dodd-Frank Title VIII has done two things. It's taken some of what are in essence middlemen in the financial system and added another layer of regulation on top of what's already there. Then this part of the law provided those middlemen with access to a line of credit provided courtesy of the taxpayer. These middlemen, called clearinghouses, did not ask for this assistance. I suspect they're in the same camp as most businesses when they're forced to go into partnership with the federal government. Thanks, but no thanks. These clearinghouses had nothing to do with the financial crisis. These are not the guys who made the risky trades. They're not the guys who took the bailouts. They facilitate certain financial transactions. They don't make them. They were wrapped up in Dodd-Frank all the same. Access to the federal discount window, this taxpayer's line of credit that they have been ordered to accept has never been in our history, been given to financial institutions that don't even take deposits. It's supposed to be a backstop for banks that get into trouble, not clearinghouses who have entirely different business models. There are a number of different complexities with this regulation or legislation, but fundamentally, what we're talking about here are two different approaches. On one hand, you can take an industry and you can regulate it, and when the regulations don't work, you can provide taxpayer backing. Under this model, companies are sort of public and sort of private. On the other hand, you can take the market discipline approach. Your money, your rules, your profits, and your losses. That's how the free market is supposed to work in theory. Mr. Chairman, I'd also suggest that this is how people expect it to work in practice. When we violate those expectations, we undermine the belief in free enterprise itself. That's why I suspect that 58% of millennials would rather live under communism, fascism, or socialism than capitalism. They're the ones who in part came of political age during the bank bailout. Nobody is going to support a system that is based on the notion of public risk and private reward. That's Title VIII in a nutshell. Clearinghouses are for-profit private entities. Maybe they'll never need the discount window, but by giving it to them and then calling them systemically important, we have significantly increased the chances of a future problem. Sheila Blair, the former FDIC chairman, has said that it's in large part the case with Title VIII. Even Barney Frank opposed the addition of this title in this committee to Dodd-Frank, calling it overreach. New York Times columnist Gretchen Morgensen said that, quote, these large and systemically important financial utilities that gather, trade, and clear trillions of dollars in transactions appear to have won the daily double, access to federal money without accountability, end quote. Mr. Chairman, Title VIII has set up the pieces for a future bailout scenario. Today, we have the opportunity to begin reversing that decision. I do hope so before circumstances lead to another bad outcome for the taxpayer. So I urge support for this bill, and I yield back the balance of my time.
The gentleman yield.
I yield.
The gentleman yields. Thank you, Mr. Chairman. I'm a co-sponsor of this important legislation. I thank my colleague from North Carolina, Mr. Budd, for introducing it. Title VIII of Dodd-Frank is a glaring example of how this deeply flawed law perpetuates too big to fail by interlinking the entire financial system into one government-run utility. As we've seen time and again, imposing these new standards on non-banks is expensive, duplicative, and damaging to the flow of credit and capital in the private economy. By repealing the broad and undefined powers granted to the Federal Reserve in Title VIII, prudential regulators can once again focus on banks, and non-bank clearing, payment, and settlement systems can be regulated by the CFTC or SEC. I support this common sense legislation. I appreciate Congressman Budd for his strong leadership in introducing this bill. I urge all of my colleagues to vote for it. Thank you, and I yield back.
Gentleman yield his time back from North Carolina.
Yield back to the chairman.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I move to strike the last.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, before I share my statement, I'd like to yield some time to Mr. Budd because I want to hear what he said about the millennials and what they prefer. If you don't mind, I would yield time to you to at least repeat that statement about the millennials.
So what we see here is because of the financial crisis and government intervention, it set a precedent that government was excessively necessary. And as those millennials were coming of age, it gave way to the belief that different systems of government, other than the ones that we have, are better than the ones we've had for 241 years.
I'm sorry. I would like to continue to yield because I wanted to hear the exact words because I don't want to not understand or misquote you. I think you were specific in talking about the systems they would prefer to live under. Would you kindly repeat that?
My words exactly, Ms. Ranking Member, were that 58% of millennials would rather live under communism, fascism, or socialism than capitalism. They're the ones that came of age and political age during the bank bailout. I yield back.
Thank you very much. Mr. Chairman, H.R. 4247 is a dangerous bill that would eliminate an important regulatory regime created in the wake of the 2008 financial crisis, the worst economic disaster since the Great Depression. While there were several contributing factors to the financial crisis, one significant contribution identified by the Financial Crisis Inquiry Commission was the over-the-counter derivative market, which fueled the creation of high-risk mortgage-backed securities. Over-the-counter trading of credit default swaps, a sort of insurance against losses from a risky investment, created a false sense of security in the markets and encouraged Wall Street investment banks to buy riskier and riskier debt. When the mortgages underlying these securities began to default and swaps sellers such as AIG found themselves without the resources to pay out insurance claims, devastating losses spread across the highly interconnected U.S. financial system. The ensuing crisis ravaged the U.S. economy, destroyed trillions of dollars of wealth, and put millions of Americans out of their jobs and their homes. It also exposed serious inadequacies in our financial regulatory system. Large segments of our economy were operating with little or no oversight, federal or otherwise. Democrats responded by passing the Dodd-Frank Act to strengthen oversight of Wall Street and give regulators the tools to end the era of too big to fail and taxpayer bailouts. These reforms eliminated loopholes that allowed risky and abusive practices to go unnoticed and unregulated. H.R. 4247 would do away with the entirety of Title VIII of the Dodd-Frank Act, a critically important set of provisions that enhanced oversight of the financial markets, plumbing, the clearing, payment, and settlement processes for derivatives and other securities. Additionally, the Title VIII authorizes the Federal Reserve in coordination with other federal agencies to supervise and regulate certain systemically important financial utilities, including clearinghouses, who process, and complete trillions of dollars of financial transactions. Title VIII also gives the Federal Reserve power to take emergency enforcement action against certain entities in the event of imminent risk of substantial harm to financial institutions, critical markets, or the U.S. financial system. The wholesale repeal of such an important regulatory regime is unwarranted and irresponsible. As Columbia Law School professor John C. Kofi Jr. has put it, and I quote, "In an increasing complex world where cybersecurity concerns grow daily, payment and clearance systems also need supervision. The failure to recognize this need for oversight is to don self-imposed blinders," quote unquote. I hope my colleagues are not blind to the inherent dangers of H.R. 4247. I hope we see this bill clearly for what it is, dangerous legislation that would once again allow unchecked systemic risk to hurt hardworking Americans. And with that, I would like to say to Mr. Budd, I think he should take the opportunity to retract his statement. Of course, we will have to expose the statement to millennials because I don't think that he has properly represented any 58% of millennials in suggesting that they would rather live under communism.
Time of the gentlelady has
the
expired. For what
democratic
purpose does the gentlelady from Missouri seek recognition?
I move to strike the last word.
Gentlelady's recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank the gentleman also from North Carolina, Mr. Budd, for his leadership on this issue. The Restoring Financial Market Freedom Act of 2017 will repeal all previous FSOC designations of systemically important financial market utilities, while also removing an unnecessary federal backstop. By creating the perception that these firms are too big to fail, the Dodd-Frank Act incorrectly assigns blame for the financial crises and exposes the taxpayer to potential losses. The Dodd-Frank Act, to put it mildly, was an overreaction to the 2008 financial crisis that expanded government regulation into every aspect of our financial system. In this instance, Title VIII expands the Federal Reserve's regulatory authority into a space where it previously did not have any expertise. Instead, Dodd-Frank concluded that private companies cannot or should not competitively provide financial services. In addition, Title VIII of Dodd-Frank gives these systemically important payment, clearing, and settlement companies a distinct advantage over their competitors by giving them access to so-called emergency funding. Again, I think it is important to reiterate that no clearing houses or payment system required a bailout during the financial crisis. FSOC's belief that these public utilities create a systemic risk that could lead to the next financial crisis is at best misguided. Expanding government control over these private utilities will not hurt competition, but impose a duplicative, costly layer of regulation. I urge all members of the committee to support Mr. Budd's legislation. I yield back.
Would you yield to the chairman?
I will yield to the chairman.
I thank the gentlelady for yielding. Such a misguided section of Dodd-Frank that needs to be repealed. I want to thank the gentleman from North Carolina for his extraordinary leadership here. I mean, Title VII, for example, didn't mitigate risk, it concentrated risk. It absolutely concentrated risk in our CCPs. And then what the ranking member describes the gentleman from North Carolina's bill to be dangerous, well, a little bit of history, having served on the conference committee of Dodd-Frank, as I know the ranking member did, she may recall there was a Republican amendment to strike the provision, which is what the gentleman from North Carolina is doing now, and none other than Chairman Barney Frank supported it. Chairman Barney Frank supported what the gentleman from North Carolina is trying to do now and called it, quote, an example of overreach on the part of some of the Federal Reserve. Now, unfortunately, because of our friends on the other side of the Capitol, it ended up in the final product. But again, it is important to note that it was opposed by Chairman Frank. It was also opposed by Sheila Bair, the former FDIC chair, who warned about granting these financial market utilities access to the discount window. And says, quote, not only gives these firms a real advantage over non-systemic competitors, it opens up taxpayers to potential losses and creates moral hazard. That's what former chair Sheila Bair, former chair of the FDIC, had to say. She went on to say that FMUs will very likely become the new government-sponsored enterprises and called it a, quote, unwarranted expansion of the government safety net. And so what the ranking member says is dangerous, well, the former FDIC chair, Sheila Bair, apparently respectfully disagrees, as does former chairman Barney Frank, who last I looked had his name on Dodd-Frank, would tend to disagree as well. And so I think it is a uniquely bad idea to concentrate risk into these CCPs, much less give them access to the discount window. It will become a self-fulfilling prophecy that they become systemically important. And so it is incredibly important that Title VIII of Dodd-Frank be repealed and that we eliminate this financial market utility designation in order to designate a whole new class of SIFIs, a uniquely bad idea. I thank the gentleman from North Carolina for offering this repeal bill. I yield back to the gentlelady from Missouri, whose time now has expired. For what purpose does the gentleman from Georgia seek recognition?
Yes, Mr. Chairman, strike the last.
The gentleman is recognized for 5 minutes.
Mr. Chairman, I've listened to what you said, and of course, you know, I have great respect for you and also my good friend, Mr. Budd, certainly respect his concern about Title VIII. But let me just share with the committee that I am the ranking Democrat on the subcommittee in agriculture, of commodities, exchanges, credits, energy, and we handle the issue of derivatives, swaps, clearinghouse, and cross-border, the whole 9 yards. So I'd like to take just a few moments to kind of clear the air on why this is a terrible idea. With all due respect to my friend, Mr. Budd, I recognize his concerns about too big to fail over clearinghouses. But let me just share with you, and as we listen to the chairman, all that is true. We all were here when we put Section 8 in. But yes, there may have been some concerns from Sheila Bair and others. But it was the CFTC, the Commodities Futures and Trading Commission. It was the Securities and Exchange Commission that came to us. At that time, derivatives, swaps, all of this was just a burgeoning kind of industry. But ladies and gentlemen, now this makes up $807 trillion piece of the world's economy. And you mean to tell me we are now going to disavow the section in Dodd-Frank that gives us the governance to look into it, to regulate it, to make it? Ladies and gentlemen, we are the #1 financial system in the world. Why would we want to disavow ourselves from perhaps the fastest growing part? All this is risk management. And let me just say something about the apex of his concern, the clearinghouses. The ability of our clearinghouses to help stabilize the marketplace, to help mitigate risk, that is the key part that is played in having an American healthy financial system throughout the world. We are a world player in this. We have cross-border negotiations. We need equalization. We have certain dramas that are happening around the world. We have England and Great Britain now exiting from the European Union. Prior to that, the European Union and the United States were the two dominant players. We have all kinds of things happening in the world, and we do not need to divorce ourselves from the world marketplace, particularly in this area of the clearinghouses. And let me point out to my good friend from North Carolina, Mr. Budd, that there has never been a failure of a single clearinghouse, even during our last big financial crisis. And so while I recognize, again, your concerns over the too big to fail, I just want to ask you, Mr. Budd, and any member that might be voting in support of this measure, if you have fully weighed the risk that we will have if we disavow Section 8, what it would have on destabilization of the marketplace and weaken ourselves as the premier, #1 financial system in the world. The rest of the world would be shook up over this because the United States is the key player. And I just urge every member here to think seriously of how this will push the United States financial system and as a premier financial player on the world stage down. Thank you, Mr. Chairman.
Time of the gentleman has expired. For what purpose does the gentleman from Michigan seek recognition? I'm not sure the gentleman's microphone is on. The gentleman's recognized for 5 minutes.
Or use this one as well? All right. So to my colleague from Georgia, you've got one. you've got one of those people who believe that this is the right thing to do. And here's why. And it was interesting. You heard the gentleman from Georgia talk about the fact that there was never a utilization of this, nor was it ever asked for by these organizations and these clearinghouses. They didn't ask for this help. This is, or they never asked for help, and I'm not sure they view this as help. And what I think between the lines is there really is a philosophical difference here about the proper size, role, and scope of government. This side believes that if the federal government doesn't have a key element and component to the operation of the business, that it should stay out. It seems your side of the aisle believes that at every opportunity, the federal government needs to inject itself into it. And it's important to point out that the SEC and the CFTC already have the authority to write rules for clearinghouses. So you're looking for another venue or another avenue in for government intervention.
Would the gentleman yield for one moment?
I'm happy to yield for a moment.
Now, I just want to clear the air because it was the CFTC and the Securities Exchange Commission that came before our committee. And they both wanted the jurisdiction to cover this area. And what we mandated was that they both would have it, but we put a criterion there that they must harmonize.
Reclaiming my time on that, and that's why there was never a hearing on it? I mean, there's so much stuff that got airdropped into Dodd-Frank without a proper actual examination of the need of it, and that's why, if I recall, the chairman himself, Barney Frank, opposed it and voted with the Republicans to not include it. So this is clearly the Federal Reserve and others trying to get in to an area that this member believes is unnecessary, unneeded, as you had pointed out, has never been utilized, never asked for. And again, this is about protecting taxpayers as well as the system. The system has proven it's robust and can withstand the greatest of shocks without government direct intervention. And guess what? We are now putting a firewall between taxpayers' hard-earned dollars and the necessity for businesses to make sure that their decisions are good decisions. I did want to take this opportunity as well to offer up to my friend Mr. Budd an opportunity to comment on a few things that have been said. And with that, I'm happy to yield to the author of the bill.
Thank you to the gentleman from Michigan. As I look back to listen even more clearly, I see the gentleman's painting from the state of Massachusetts, and I'm reminded of his name being on this bill that we have repealed in part. And as we look at this, I also look at the fact that he actually didn't even agree with this. He was the Financial Services Committee chair, and he even led and supported he supported the Republican-led effort to strike this provision from the bill, which we're doing right now. So I'm not sure what happened between then and now to make my colleagues on the other side of the aisle not still support where then Chairman Frank wanted this struck. Now this provision it found its way back into the conference report. So it wasn't even in this committee where it found its way back in. So I'm a little bit mystified at why this is even being debated. It was once a bipartisan issue, and now for some reason it's not. So I thank the chairman, thank the gentleman for yielding me time.
Time of the gentleman has expired. For what purpose the gentleman from Illinois seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thanks, Chairman. I'd also like to thank Congressman Budd for sponsoring this important legislation. We spend a lot of time in this committee discussing systemic risk, especially as it relates to financial institutions and non-banks like asset managers and insurance companies, but we spend relatively little time discussing the role of central clearing parties in our financial system.
As has been mentioned, Title VIII coupled with Title VII of Dodd-Frank creates new questions about the role of government in promoting financial stability. I generally believe that government causes more problems than it solves in our financial markets, even when the intentions are pure. Dodd-Frank provides the Financial Stability Oversight Council authority to designate a financial market utility as systemically important. Relevant to the discussion today, this means the entity is subject to be supervised by the Financial Reserve and subjected to enhanced prudential standards. The entity's access to the Fed's discount window and also the ability of the entity to maintain accounts with the Fed. If anything, the committee has heard a significant amount about how burdensome it is to be supervised by the Federal Reserve, especially for depository institutions with greater than $50 billion in assets. Designated FMUs are subject to the heightened prudential and supervisory provisions of Title VIII, including conducting their operations in compliance with applicable risk management standards, providing advance notice and review of changes to their rules, procedures, and operations that could materially affect the nature or level of their risks, and being subject to relevant examination and enforcement provisions. This regulation is highly prescriptive and extremely burdensome. I'm confident that systemically important market utilities do not appreciate the Fed criticizing every aspect of their operations. I can say this with some certainty because a few of these SIFMUs are located in Illinois. However, unlike what the critics of this legislation might expect, these market utilities, as far as I know, are not requesting repeal of Title VIII. These entities facilitate transactions for companies in Illinois and around the world. There's no question they play an integral role in the financial system, and Congress should be attentive to assuring that they do not pose any systemic risk. Title VIII also provides SIFMUs access to the Fed's discount window, but only under very narrowly defined circumstances. One thing the drafters of Title VIII might have done right is making it extremely difficult for SIFMUs to access the discount window. Title VIII of Dodd-Frank provides an option for these market utilities to maintain accounts with the Federal Reserve. I understand this has only recently become a reality for some of the market utilities. Ensuring sufficient liquidity during stress periods is one of the primary risk management responsibilities of central clearing parties. However, the Basel capital and liquidity standards make banks less inclined to accept cash deposits from central clearing parties and cash collateral from the clearing members. The ability to maintain accounts helps these market participants manage their obligations under the Basel capital and liquidity rules. I'm supportive of Mr. Budd's legislation and making sure too big to fail is not enshrined in federal policy, and I hope that this is an aspect of Title VIII this committee will continue to keep in mind. Again, I'd like to thank Congressman Budd for sponsoring this legislation. I support H.R. 4247, and I yield back the balance of my time.
Gentleman yields back. He seeks recognition. There's no further discussion or amendments to the bill. The question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does the gentleman from North Carolina seek recognition?
I ask for a recorded vote.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered. Pursuant to subsection C5, Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4289. The clerk will report the bill, which was distributed in advance.
H.R. 4289 to amend the Dodd-Frank.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from West Virginia, Mr. Mooney, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. Thank you for this opportunity to present this bill. Similar to what the bill we just heard from Congressman Budd, this bill repeals a part of Dodd-Frank. It specifically repeals Section 1503, requiring mining companies to include information about mine safety, health violations, orders, citations, legal actions, and mining-related fatalities, and quarterly annual reports with the Securities and Exchange Commission. These disclosures are largely based on the safety and health requirements that apply to mines already under the Federal Mine Safety Health Act of 1977, administered by the Mine Safety and Health Administration Committee. So these are duplicative requirements, Mr. Chairman. These SEC rules and requirements established in this Section 105 are already required by the Department of Labor's Safety and Health Administration. I know there's some opposition to it, thinking duplicative regulations are somehow helpful. I guess by that logic, you could have the EPA, Department of Interior, Army Corps of Engineers, and a whole bunch of other groups administer the exact same set of regulations and standards. These are duplicative regulations. We're empowering the wrong bureaucracy with this Section 1503. The Securities and Exchange Commission is tasked with protecting investors, maintaining fair, orderly, and efficient markets, and to facilitate capital formation. The SEC is to set rules and requirements for Wall Street, banks, and investors. It should not be regulating a labor-intensive industry such as mining. Disclosures are harmful and counterproductive to companies who are mandated to disclose this information. These cause increased compliance costs that could be invested to create jobs or otherwise grow a company. I've seen estimates as $1 million to comply with these regulations. $1 million could be $10,000, $100,000 coal mining jobs. I'd rather see that $1 million spent to employ 10 coal miners at $100,000 a year, which are good paying jobs in West Virginia and other states in this country, than on disclosure requirements that are duplicative anyway. I do want to thank the U.S. Chamber of Commerce for supporting this bill. They have said that we believe that repealing Section 103 of the Dodd-Frank Act, that such disclosures are an improper use of the securities laws, will likely have unintended consequences down the road. Other areas of law already address mine safety issues, and these types of mandates only add to the problem of disclosure overload, which harms investors and places significant cost burden on the capital markets. Also want to thank the National Mining Association for their letter of strong support for this bill. The Mining Association states it well. They said that my bill, the Section 1503 of the Dodd-Frank, requires SEC to issue a rule for mining companies to disclose certain mine safety information is both duplicative of existing requirements and distractive. That this Section 1503 was added to Dodd-Frank in the conference committee in the middle of the night with no hearings. Just as my colleague, Mr. Huizinga from Michigan, mentioned the airdropping in of the last bill we debated, this was airdropped in with no hearings into the Dodd-Frank bill. And it wasn't vetted. The same, so going on to read the National Mining Association's letter, it says the same safety information required by Section 1503 is already made available on a timelier basis by the Mine Safety and Health Administration. Section 1503 is simply a duplicative requirement that does not serve either safety or investor awareness. So I know we've had a lot of debate about Dodd-Frank and these issues, Mr. Chairman. I'll go ahead and yield my time back to the chair.
Gentleman yields back. For what purpose does ranking members seek recognition?
I move to strike the last word.
Gentleman is recognized for 5 minutes.
Yes, I'm going to offer my reasons for opposing this legislation, but I really can't believe that this legislation is even being offered. On April 5th, 2010, an explosion ripped through the Upper Big Branch mine in Mount Cole, West Virginia, resulting in the loss of 29 miners. This tragic loss of life highlighted the need to do more to make workplace health and safety a top priority of all coal companies. It also became clear that shareholders have a direct and material interest in the safety record of any mining company in which they invest, and that safety has as much of an impact on a company's long-term financial health as its production. For this reason, Section 1503 of Dodd-Frank Act included comprehensive new reporting requirements for publicly held mining operations in an effort to make mine safety and health statistics for operators of U.S. and U.S. territorial mines more transparent to the public and to investors. Section 1503 of the Dodd-Frank Act requires covered companies to report to the Securities and Exchange Commission certain enforcement actions, including significant and substantial violations, unwarrantable failure and flagrant violations, closure orders for failure to abate or for an imminent danger, and pattern of violation notices and orders. Companies must also disclose the total number of fatalities, the total number of assessed penalties, and information about their cases pending before the Federal Mine Safety and Health Review Commission. The SEC has issued its final rule for Section 1503 in December 21, 2011, and nearly 6 years into these requirements, affected companies appear to have adapted well to the additional disclosure requirements with little evidence of challenge to the SEC or difficulty in following the rules. Further, based on the SEC's publicly available review correspondence to date, the SEC has had little to criticize with respect to companies' mine safety disclosures under Section 1503. Mine safety and health issues are obviously very important to the lives of those who work in mines, but they are also important to the operations and therefore the financial performance of companies operating in the mining industry. Therefore, an understanding of these issues is important to investors as well. For these reasons, I urge my colleagues to oppose 4289, which would repeal a number of important disclosure requirements regarding mine safety and health violations. And I must add in my conclusion, I don't understand why anybody would be interested in getting rid of 1503 that obviously is about safety of mine workers. Gee, I just don't get it, but I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Michigan seek recognition?
Mr. Chairman, I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman, and I think the ranking member is onto something here. Safety is extremely important, and that's why we have safety laws. My family happens to operate a sand and gravel operation, which is regulated by MSHA, Mine Safety and Health Administration. We have annual inspections. These mines have annual inspections. What cannot be offered up here today, though, is a single reason why the Securities and Exchange Commission should be the one to be the safety enforcement authority. And I'll point out, again, that the Securities and Exchange Commission only regulates publicly traded companies. What about all those private companies? So are we going to have, say, somehow or another that privately held mines are exempted from this? Or why not then take the logical conclusion and exempt them from MSHA? If the Securities and Exchange Commission is so darn good at doing this, why don't we put it all into Securities and Exchange Commission? It's not their job. And as we had a discussion, not in this section 1503, but in 1502, you saw Mary Jo White earlier say about the conflict minerals. It's not their bailiwick. As much of an important issue as it is to address, the Securities and Exchange Commission is absolutely the wrong vehicle to do that. We have those enforcement agencies in place. Allow them. If they need to be beefed up, then let's see an amendment to do that. Oh, and again, that would be in a different committee. Not forcing the Securities and Exchange Commission lawyers to go and figure out what is proper mine safety. So that I think is the most glaring element that we see here today. Not a single reason why the Securities and Exchange Commission is the proper avenue for safety enforcement has been demonstrated here. And I did want to take this opportunity for my friend from West Virginia, if he needed a moment as well, to continue his conversation. With that, I'll yield to the gentleman from West Virginia.
Thank you to my friend and colleague from Michigan. I just wanted to reemphasize the estimates I've seen in these mines, it's $1 million. So if we're talking about why I'm offering this amendment, we'd rather put that $1 million into employing hardworking Americans to feed their families and get these good-paying jobs. My state has been ravished with the war on coal and overregulation on the coal industry in so many ways, and this is a small but significant way of helping get rid of duplicative paperwork and allow folks to be employed in those mines so they can feed their families. So I thank you for your comments pointing out some of the issues with mine health and safety and the germaneness of which department does this. So I'm going to yield my time back to the to the chair?
Reclaiming my time, I just want to point out that in October of 2017, the Treasury Department recommended that Congress repeal this Section 1503. And further, Treasury then recommended that to the extent Congress determines that it's desirable to require disclosure of all companies, this oversight responsibility should be moved from the Securities and Exchange Commission to an appropriate agency such as the Department of Labor. So if there was an amendment that did that, that would make way more sense than simple opposition to the Securities and Exchange Commission, which, well, by the way, is continually complained by on the other side of the aisle that they don't have enough resources to do the jobs that they are tasked with. So now we're going to junk it up with more tasks that they have no expertise or background in. So that's exactly why removing Section 1503 from Dodd-Frank, or 1502, or a number of these other provisions that the Securities and Exchange Commission has no background in, why that is the proper thing to do. And with that, Mr. Chairman, I'll yield back the balance of my time.
Gentleman yields back. Who seeks
Chairman.
recognition? For what purpose does the gentleman from Georgia seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I yield time to the ranking member, Ms. Maxine Waters.
Thank you very much, Mr. Scott. I appreciate that. What I've heard in this debate is that this is overregulation, that there are enough laws on the books, enough regulations concerning safety, and we don't need this. This is government intervention where it's not needed. If that is the case, why then, Representative Alex Mooney, have you basically voted with the state's other House members in favor of a budget cut for the existing safety rules and laws by cutting the U.S. Mine Safety and Health Administration? I yield time to Mr. Alex Mooney if he would like to help us out and help us to understand why, if you are presenting this legislation because you think that there are too many rules, too much overregulation, that you already have in law, safety laws, rules, and regulations that are sufficient, why then are you out to cut the budget for the U.S. Mine Safety and Health Administration? Thank you very much, Mr. Mooney. I was yielding to you so that you could help us understand that. I will reclaim the time that you did not claim.
Well, if the gentlelady will yield.
I yield.
Okay.
Yes.
I'll give you 20 trillion reasons, and they click across on that screen every single time you have a Republican speak.
Well, I don't want that many. I just want one.
The future of our children and the $20 trillion in debt that we have accumulated.
Will the gentlelady yield?
That does not, reclaiming my time, that does not speak to the issue. Yes, I'll yield to Mr. Barr.
I appreciate the ranking member's question, because everybody in this committee, every one of us, especially those of us who represent coal miner and coal miner families, we care deeply about the safety of these men and women, these heroes to our country who deliver reliable, affordable energy to the American people and for generations have literally powered America. Literally powered our
Reclaiming my
economy.
time, sir, reclaiming my time. I yield the balance to Ms. Waters.
Thank you very much. The proof of the pudding is in the eating. If you care, it is demonstrated in very, 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 very understandable ways.
Will the gentlelady yield?
It's not my time. It is important that if you care so much, and you say you do, and I don't have any reason to really believe you don't care, maybe you're just misguided in the fact that you are attempting to cut the very administration that's responsible for the safety of these miners.
Will the gentleman yield?
And with that, I hope the gentleman does not yield his time back. I have the time at this point, and I would like to continue to ask the question, or basically to raise the question, that if you care so much about these coal miners, why then would you support eliminating the oversight and the implementation of the very safety laws that you say are sufficient to provide the safety that is needed, and that you don't believe that there needs to be additional regs or laws because enough are, in fact, in operation? And so, having said that, I will yield back the time to the gentleman who yielded the time to me, Mr. Scott.
Will the gentleman yield so I can answer the gentlelady's question? Thank you. I appreciate the gentleman, and I appreciate the spirit in which the legitimate question was asked. It's a very legitimate question. And the answer to the question about what the budget of MSHA should be, MSHA is an important regulator. We need regulators in mines to make sure that the men and women who are in there are safe. Absolutely true. The problem is that as a result of 8 years of President Obama's war on coal, the employment among miners has plummeted. The number of coal miners in Kentucky is at a 118-year low, but the number of mine inspectors has gone up. And so you literally have more, because of the budgets of MSHA, the number of mine inspectors has gone up, and the number of coal miners has dropped in Kentucky, in my home state of Kentucky, by 10,000 coal miners. So the time has
Time of the
expired.
gentleman from Georgia has expired, who seeks recognition. For what purpose is the gentleman from Kentucky seek
Move to strike the last word.
Gentleman's recognized for
So
5 minutes.
Thank you. So just to finish the point, and again, let me first at the outset restate the very important point. All of us here believe very firmly and adamantly that we should have mine safety regulation that makes sure, first and foremost, that we never ever have accidents like Upper Big Branch. That is so crucially important. But we also have to recognize the economic reality of what's happened over the last 8 years under the war on coal, what's happened in coal mining, which is that employment has plummeted. And in my home state of Kentucky, which is the third largest coal producing state, was the third largest coal producing state in the country, we've lost over 10,000 coal mining jobs. And those are paychecks that supported families and extended families. And as I said before, this has left Kentucky with the fewest number of coal jobs in 118 years. So here's the question: how are we going to make sure that we have more jobs available? And what this bill, and I compliment the gentleman from West Virginia for offering this legislation, what this bill does is remove a burdensome requirement that is another hurdle for coal companies to access capital. Because when we talk about the decline in IPOs in this country, why are fewer companies going public? Because of burdensome requirements that do not contribute or enhance safety in any way whatsoever. And in fact, I would argue, based on the conversations I've had with many of the coal operators in Kentucky, that the requirements in 1503 of the Dodd-Frank law actually affirmatively mislead prospective investors. How is that the case? Because the disclosures that are required in these securities filings are not updated in a timely manner. And so what happens is there could be a violation or citation or order that's issued that is inaccurate, that the mining operator contests. The mine inspectors have come in, they've issued a fine or a violation because there's 5 inspectors for every 1 coal miner because they've lost all their jobs, and they've made a mistake, an error. The coal operator appeals that error, but because the appeal is so bureaucratic and takes such a long time, and these settlements happen well into the future, the company is actually required to disclose alleged violations and citations that are false. And so what we're doing here is we're eliminating the possibility that this securities filing requirement misleads the investors. And a University of Maryland law article explains this. And in the law article, it says, some of the mine safety violations individually reported on Form 8K following enactment of Section 1503 do not appear to be material in any way to the understanding of the issuer's mining operations or the risk profile of those mining operations.
As a result, issuers have felt compelled to explain in the context of these disclosures that problems were corrected or there was no adverse impact on the operations as a result of the order or notice. The new requirement thus runs the risk of creating unnecessary noise in the public reporting for issuers' operating minds. Now, for those investors who believe this information is material to their investment decisions, that's fine. These disclosures may be relevant and material to those investors. But the more accurate way of obtaining this material information is on the MSHA website, which is updated in real time. The disclosures required by Dodd-Frank are late in time. So I would argue a simple reference to the MSHA website is a better way to hold coal operators accountable for their safety records. It's also a better way in real time to disclose accurate material information about the safety record of these mines, these mine operators.
Will the gentleman yield?
I will.
Very quickly. I'm curious, could it be that the last administration simply wanted to cast this industry as a dirty, needlessly dangerous, and unnecessary industry?
I appreciate the gentleman's question. I'll reclaim my time, and that's a great way to conclude my remarks here, because what we saw over the last 8 years was a total and complete war on coal. President Obama's science advisor said a war on coal is exactly what we need. And this provision of Dodd-Frank is piling on. It not only misleads investors, but it is death by 1,000 cuts. It's why in Kentucky we have lost 10,000 plus jobs, because you're putting you're bankrupting a coal industry that's literally powered this country for the last 100 years. And no wonder we don't have companies going public in this country anymore, because it's just piling on, over-regulating, and it's not in any way contributing to the safety of our men and women in the coal mines. Yield back.
Time of the gentleman has expired. Who seeks recognition? I understand the ranking member seeks recognition for purposes of unanimous consent request.
Thank you very much, Mr. Chairman. This is a letter that's addressed to you and I. And this is a letter said, it has come to the attention that the committee tomorrow is marking up.
Is the gentle lady, the
HR
ranking member,
4289,
asking unanimous consent to
unanimous
insert in the
consent.
without objection? There being no further
This
discussion
is a letter from the
or
United
amendments.
Mine Workers of America wholeheartedly
The
opposing
ranking
this
members'
legislation.
comments are not in order. There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For
Chairman,
what
I'd
purpose?
like a recorded vote.
A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5, Rule 3 of the committee rules, the vote on this question is postponed. There being no further bills before the committee will stand in recess, subject to the call of the chair. The chair anticipates that we will reconvene immediately following the next series of floor votes. The committee stands in recess.